Hello, traders. Sorry about that delay. Something's up with YouTube this morning, and so had to kind of fix that while I was live. Apologize for that. This is it's 8:02 a.m. Chicago time, 9:02 Eastern on Wednesday, the 14th of August, 2019. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This is episode number 1574. And here we are after the day of this massive tariff deferment to December that was announced yesterday right after the open, which caused an exceptional pop, 65 points or so in the S&Ps. A 4 standard deviation move in the S&Ps in terms of the initial balance. And now we're back to the scene of the crime. Basically, we haven't really tagged the SOC, which is down at 2879.75, which coincided with yesterday's open. Okay, so that's where we stand this morning. Risk off sentiment. The bonds are very strong, up a handle and 13 ticks in the future, a 0.86 versus settlement yesterday. That's outstanding. Big push up. Yields coming down. If you have not been paying attention to the yield curve, you might want to give it a quick look because that's going to continue to come into play. The 210s are inverted now. I'll show you that in a minute. Well, that happened overnight, but I'll show you how flat it has gotten. And of course, I'm not going to sit here and say when the yield curve flattens or inverts, then the bear market's here or whatever, because many people have written about this, and have shown empirically that actually it takes some time after that the effects are shown. Also, the environment is so globalized now, and there are swaps, and there are all kinds of things going on. With we can't look at yield curves in a sort of a vacuum anymore, in my opinion. It's been very interesting to listen to and learn about the macro picture from various experts, and there's a lot that can be learned there. In any case, risk off today. Again, the bonds are far and away much stronger. A handle in 8 ticks. So far, gold is up, trading $1,525, up 0.8% or $12.20. The yen is up. The 10-year notes are up 14 ticks, and the euro bund is up 42 ticks. The pound is up slightly, and so on. Crude oil's off $1.65 on the September contract, down 2.87% on pretty decent volume so far. The crude has traded 215,000 contracts. That's much higher than usual. The DAX is off 237 points this morning, down 2%. The Euro Stoxx down 1.82%. The Nasdaq's down 119 points, or 1.5%. So is the Russell, 1.5%. The Dow, 1.4%, 376 points. You get the point. Essentially, just clearly risk off this morning. We are likely to resume. We're likely to resume where we started yesterday. Essentially, the scenarios are the same as yesterday's. I'll spend just a second on reviewing yesterday's stuff. Actually, first, we got some pretty important releases. German GDP came in line at negative 0.1. Great Britain inflation rate came in stronger, 2.1 versus 1.9, and the Eurozone GDP growth rate came in at 0.2% in line. And then we got U.S. import and export prices about a half hour ago. We expect crude oil inventories at 10:30 Eastern, an hour after the open, expecting negative a draw of 2.775 million barrels, and in gasoline expecting a surplus of about, what is that, 225,000 25,000 barrels, very small number. So let's get into it. Here's yesterday. Yesterday, we were opening just beneath the prior day's point of control on the edge of the lower profile. And so the idea yesterday, based on what blah, 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 what I talked about, um, and the fact that we got below 93 the session before, and I discussed that, below 93 on Monday, we're likely to start trekking down to 54 as the next key test area. The action on Monday shifted the point of control up, but the expectation is that we would take out the low. If anything, we are likely to revert back into that 2890, 93 area before continuing lower and finishing lower on the session. What was expected. The second scenario is a test up and then just a grind down, a trend down, a slow trend down. And then, of course, we got this crazy news. My Trump tweetometer was off yesterday because it didn't warn me like it warned other traders in the market that news was coming, and it just blew up, basically blowing the entire plan uh, out of the water. And so, with that, so here's the open, which coincided with the announcement, and then we push up, and then we basically flag for the session. So for the entire session, we just built this flag, and normally flags, if the session was long enough, look at this excess low we've left behind here. These excess lows are actually very clear, very clear trade. Once it gets into the thin part of the profile, it starts to trickle down back to where it came from. But had the session been longer, the expectation would have been that the market would flag and then take out that high at least with a continuation and then potentially a correction down. It wasn't able to do that overnight. It just basically sold off uh, slowly in the Asian session and then pretty aggressively once the European session started. But we do have an excess. I'll show you that on the market profile chart from yesterday. Why is this way down here? So there it is. There's B period. So what we have here is the open is marked with an O right down there. We have the open and then B period, which is the first 30-minute block, goes up to 29.17 and a quarter. 29.17 and a quarter. So yesterday, if it had broken lower, consolidated, pulled back weaker, and pushed through 29.17 and a quarter, that would have been a short. That would have been a short to the prior day's high, at least 29.08 and a quarter. So that's about 8 points or so, and then a trip down towards the SOC. But of course, we didn't get that. We didn't get that opportunity. It happened while I was sleeping. In that the market started to move down and gave up everything that it had done in yesterday's session. Here's the overnight session right here. We reopen right where we closed, and the test higher was pretty weak. I mean, it's pretty lousy test higher. I mean, you would expect it to try out for that 44 and a quarter at least. Couldn't do that. Came down, pushed a new low, lower high, and then from there it was a pretty strong trend down in price, and you could see the distributions, multiple distributions as price discovery ensued, and we have the point of control at the lower end of the range at 28.90 and right up against it at 28.89 currently trading. So overall, the overnight inventory short in price and in volume. Uh, um, uh, so the general gist here is that the market basically discounted what happened. A quick look And I've shown this chart before. I think this is a great service by stockcharts.com here. You can animate this thing. You can set it to play, and it'll play back, you know, the yield curve all the way from like 1999. I'm not going to have you sit through the yield curve from 1999. On the right, this chart here, this is a bad color. Let's change that. This chart here is the S&P 500 cash. This is the yield curve. The yield curve, if you didn't know, is a plot of the yield or the interest rate on various maturities. So 3-month, 2-year, 5-year, 7-year, 10-year, 20-year, 30-year. There's also the ultra bond out there in the futures as well. But this is the yield curve, the normal yield curve. This is a normal yield curve. So the stance of a yield curve is normal in that you're going to get less interest because there's less risk. The shorter duration, there's more interest being paid for the longer duration. In other words, if I loaned you money and you held it for 30 years, I expect to get more interest on that money because of the duration, because you're holding it for that long, right? The cost of the time value of money. Basically economics 101. So we're going to run through this and just look at how the yield curve, this is 2008 on the Lehman Brothers stuff right here, on the Lehman Brothers correction, the Great Recession as they call it. You can see the yield curve is normal, and then the Fed comes in, the markets crash, and the Fed comes in and drops rates. You see it dropped from about 2.25% down to zero very, very quickly. And the market starts to recover, a normal looking yield curve. And then as the Fed starts to act, you could see the lower end, the Fed essentially operates on this end of the curve with their interest rates, and then they operate on the far end of the curve with QE. And you can see the interest rates start rising from 2016 and onwards. They start increasing the rate as it comes up, and the curve starts to flatten. But what's happened here recently is that the curve is starting to, it's still normal, but you can see the short end of the curve is starting to invert. The 3-year is now getting more yield than the 2, 5, and 7. Okay, and that's the beginning of this thing where everybody's talking about, oh my God, the yield curve is inverting. It's terrible. It's a terrible thing. But it's gotten a lot deeper. Okay, so now what we have is the 210, the 2 yield versus the 10 yield, which as of yesterday was still positive. The 10-year was higher. This has actually gotten lower. And it just shows the quality of the risk of money in the system currently. And so it's just important to note that for the bigger picture traders, the bigger not traders, but the investors, the big picture players in the system, this stuff is really important to them. Anyway, let's get down to what we're expecting for today. For today, I'm going to be basically drawing the same stuff as I drew yesterday, unfortunately, because we're picking up right where we left off. So the way I see this, and remember I drew scenario number 3 yesterday, was an open test down, drive up. And in that situation, I was looking for 29.25. Market pushed to 29.44 on an open test drive higher. That was a low probability expectation. Again, let's not treat the news like anything else. News is very, very special. So here we are trading down in this at this 28.86 area, which is a little bit higher than where we were yesterday. We opened at 28.79.75, or about 7 points or 8 points higher than we were yesterday. But essentially, we've got the same setup. So if you would just ignore this pop from yesterday and just look at the auction narrative in the form of that news never having hit, we're essentially looking at the same thing. An open auction is likely. A test, an attempt to test up is likely. And then I'm looking for an impulse down and then for the market to start resuming its movement downwards. But I don't expect it to go too far. It may close inside of the prior day's range. The alternative and basically scenario two looks very, very similar. The expectation on scenario two is very, very similar. An open, a weak up test, an impulse down out of the range, and then we get that grind down to 28.55.54 before we get a chop or a bounce down in that area. Okay, I'm going to draw scenario three because of the influence of what happened yesterday. We may see a lot more reversion than I'm anticipating. In that case, we push lower right away, we impulse up, push back into the 2900, consolidate here, push through, and then come back down. And then we essentially end up with a day of noise where both sides continue to fight for, continue to, oh, this is three, continue to fight for control above 2,900. This Friday is options expiration. The 16th is options expiration, and we're around this 2,900 strike. So I'm looking for a bit of a fight in this area potentially. But overall, I'm going to revert back to the bias that I had yesterday. Here we go. We just dropped into yesterday's SOC at 28.79.75, pushing the low, the overnight low down to 80 and a quarter. And so we are starting exactly where we were yesterday. We basically canceled out all the action that took place in the prior session. Yesterday's volume was tremendous. It was 1.72 million versus 1.1 or so expected. 1.1 to 1.3 recently has been the norm. So I am expecting this to try higher, but overall, I expect sellers to continue to repeat what they had been doing before they got interrupted. I expect that trend to continue lower. That's what I'm looking for today. In terms of the heat map, very useful yesterday for about 5 minutes after the open. But looking at the heat map, really, there's some interesting bid action down at 73. 80 here is an important area. Remember the SOC, the U.S.-China tariff delay SOC here is at 79.75. We do have some size holding on here. This is yesterday's open and the scene of the crime. Doesn't surprise me that there's a bid that's been there all night. You could see it's been sitting here all night, this bid. And then there's this bid beneath it down at 73, and then beyond there it's 65. Those are the areas I'm going to be paying attention to. Again, I'm aiming for 54 as discussed on Monday, and when I zoom out, the last frontier of size that's sitting in the book is between 58 and 60. I'm expecting this to melt down, to continue to melt down. Above, there's nothing firm. A little bit of size up there in the 87.50 area, but there's nothing firm above us that's been sitting a while. So we'll see how that works. Generally the market's attracted to liquidity, all things being equal. We'll see how that works out. That's all I have for you. Sorry it's been long, but there's some interesting stuff going on with the yield curve and this news. Again, by the way, if you're a Convergent member and you're listening, make sure your news feed, it's included, make sure your news feed is turned on. You're not going to be able to trade the news, but you'll have an idea of the effect of the news and the follow-on releases or comments, tweets, whatever, which may impact how you might want to trade. At a minimum, your news feed will tell you to keep your hands off and just stand by because there's a lot coming across the wire. Good luck today.